So for those of you who haven't joined us in the past, we put these little events on every month for our clients to keep them in the know about what we're doing inside of their portfolio, and then to spread the word about what we do. Cush Capital is a registered investment advisory firm. We're registered with the state of Kansas, and that means we manage portfolios on behalf of individuals and trusts and estates and a couple of other advisory businesses. And we build the portfolios from the ground up, and we custom design those to meet an investor's specific risk tolerance. But what we really market ourselves on is better research. That's what motivates us, keeps us coming to work every day, is trying to find that next great opportunity to put in our client portfolios. And we work hard at that, and these events are designed to share that a little bit. We practice golden rule investing, which is another way of saying that we're fully invested alongside of our clients, which doesn't sound like a distinguishing characteristic, but if you know the industry of financial advisory services, that is actually saying something, so I'm very deliberate about pointing it out at these meetings. We're very conservative in our approach. Our first rule of investing is not to lose it, and then the growth comes second. We practice a biblically responsible approach, and we are a certified Catholic practitioner, which doesn't make us the moral authority on anything, but it is just our effort to live a life of integrity and more fully integrate what we do on Sundays with what we do in the rest of the week. And then we seek to do business with like-minded investors. So if we can create a conversation that's centered on how we see the world, our worldview, and this event is an example of how we try to foster that conversation. We found that it goes a long way towards building trust with our clients, and when we can identify those like-minded investors, we can create those long-term relationships. So here's a chart that we share every month, and we share it because it more than anything else that influences what we do is debt. And this is a chart that details the total level of debt outstanding in the United States across all sectors. So government, consumer, household sector, business, municipal. We have over $50 trillion in notional debt outstanding, and if you were to add entitlements on top of that, it would easily exceed $100 trillion. So we share this chart every month because 100 trillion is too big of a number to really get your mind around. So we have this chart which shows the effects of that over time if we stay on this trajectory. And the effects of that are interest expense that dwarf our economy in the out decades. So we call this chart the path to socialism. This won't happen, but to change this, we have to make the difficult decisions, which are raise taxes, lower benefits, or what we view as a growing likelihood of part of the solution will be the Federal Reserve stealthily printing more and more dollars to pay down these debts with dollars of lesser and lesser value. So we have created a portfolio to position our clients to benefit from that environment. Every month I try to grab a few quotes and a few slides to share with our clients and audience that we found in the last month that we consider to be meaningful. And this quote was taken from the Congressional Budget Office's report issued January 31st, where they say the federal budget will show a deficit of nearly $1.1 trillion in fiscal year 2012, higher than any deficit between 1947 and 2008 as a percentage of GDP. So we have as of yet not begun to implement any of these difficult decisions that we have to make to change our trajectory. You might recall that in October, the Federal Budget Deficit Super Committee failed. They couldn't come to any agreement on how to cut the budget, and on account of that, as the legislation is written today, we'll have some severe cuts across the board take effect in 2013. So, if that happens, the Congressional Budget Office, in their report, said that between 2012 and 2014, revenues in the CBO's baseline shoot up by more than 30%. These are the effects of the failure of the Federal Budget Deficit Supercommittee. Now, revenues, when the CBO uses the term revenues, they're talking about your taxes. That number is going to rise by 30% between 2012 and 2014. That will have a very big effect on the U.S. economy. So here's another quote that we picked out from the last month from John Malden, who's one of my favorite financial newsletter writers. And Mr. Malden says it better than I can say it, so I've included it here for all of our clients. He says, "Everyone knows by now that the United States is facing difficult choices. Depending on what assumptions you use, the unfunded liabilities of Social Security and Medicare are between 50 and 80 trillion and rising. It really doesn't matter, as there is no way that much money can be found, given the current system, even under the best assumptions. Things not only must change, they will change. Either we will make the difficult choices, or those changes will be forced by the market. And the longer we put off the difficult choices, the more painful the consequences." So a 30% rise in taxes is very painful, but that may be less painful than the alternative continued can kicking, where we find a short-term stopgap solution and push actually facing these issues on down the road to 2014 or 2015 or 2016 and have the market lose confidence in the full faith and credit of the United States government. So this chart's a little bit difficult to read on a PowerPoint slide, so I've laid a few on the tables there. But this is a different way of looking at some of those charts that I showed you on the first and second slides. This shows the household share of our national debt growing from $20,564 in 1975 to $84,793 in 2011. So this in a different form shows the same accrual of this massive debt load that we're now faced with dealing with. And then in the gray line there, you can see that the median household income over that same time has gone from $44,762 to $50,876. So this just a different way of looking at some of the imbalances that we face inside of our economy today. So now take a look at that gray line, and I'm going to show it to you a different way. So the gray line from the prior chart is the black line on this chart, or a proxy for it. This chart shows the U.S. disposable income per capita versus, in the pink line, the consumer price index. And you can see there that they start to markedly differ in about 2007. So I think most of the people I talk to, this resonates with. Prices are going up faster than incomes are going up, and it affects your household budget. So now let's take a look at that black line in another chart here and show real disposable personal income in black, and then we have real disposable personal income less transfer payments from the government in orange. So if you take out all of the debt we've been accruing at the government level and remove the stimulus measures that we've been gifting to certain portions of the populations, we're left with a much wider gap. Now compare that orange line or that yellow line to the pink line on the prior slide, and you can see that the state of the U.S. household has been deteriorating significantly over the past couple of years. So here's another slide that I wanted to share, and this shows a 30,000-foot view of the markets right now. You can think of this as the market as a percent of GDP. So take gross domestic product as a proxy for our economy at large, and what percentage of GDP is the U.S. stock market. And this chart goes back to 1924. So the long run median average here is a little bit over 60%. And we we started to drift up above that median average there about 1996, and you can see that the red line on this chart is where Alan Greenspan made his famous speech where he said, "I see an irrational exuberance in the market." Then we hit the tech bubble, and ever since we've been drifting back down to somewhere towards trend line. And we're still significantly above what you would think of as a long-run average for, this is really a proxy for valuation. What's a fair value for the markets? And this would suggest that the markets as they're priced today are by no means cheap and a little bit more expensive than they have been on average over the last not quite 100 years. So here's another chart that supports that same point going back to 1881. This is the long-run valuation of the market in terms of price to earnings. So this is what we try to do as investors. We try to go out and we try to identify companies that have good earnings streams, good profitability measures, and earnings that are likely to increase over time. And then we want to pay a good price for those companies. So that price divided by the earnings that we get as a shareholder is a key metric of what we look at. This shows that same ratio for the stock market at large, going back to 1881 here. And you can see that the average here is about 15, going back over 130 years. And today we're at about 20. This takes the earnings over the last 10 years divided by price. So just to look at where we are in the markets today. Here's a chart that shows the stock market from 1980 to 2000 during a period of time where we were accruing a big portion of that 50 trillion in debt that we have outstanding. Debt to the stock market is like steroids to an athlete. You can run an economy with excess debt for a period of time, and earnings will increase on account of that, but eventually you have to begin to start paying off that debt, and that will serve as a secular tailwind going forward. And this is the market that we've seen since 2000. It's a market that is much more volatile. It's been referred to as a muddle-through market, a new normal, a range-bound market. This is a stock picker's market. It's a difficult market for investors, and it's a market that should allow firms like Cush Capital that pride themselves on better research to prosper. So when we try to create a portfolio inside of this global worldview that we have now, we put together a portfolio that's comprised of generals, and you can think of a general as your traditional long-term buy and hold type of approach. And there are companies out there right now that you can buy and hold for the next 10 years, but it's not nearly as easy as it was 20 years ago. Beginning 1980, you could buy the S&P 500 and let it sit in your portfolio and just wait because it was going to grow. And we're not in that market anymore, so we have to really pick our spots. So we take a portion of our portfolio and reserve it for the traditional buy and hold approach, and we call those companies generals. And then we mix that with special situation investing, which we wrote about last month in our newsletter, and we have some copies up here at the front if you want to grab one of those on your way out. Some options and some hedges, and then we'll actively take bearish positions against the market from time to time when we see excessive valuations. Just to lay a quick framework before I turn it over to Mike. Mike's going to talk to you about a company called Sprott Resources that we have in our portfolio today and go into a little bit more detail how that fits into our strategy. When we look at a company, we assess it based on the 3 M's of investing, which are 3 criteria that we look for in all of our investments. That's management. A company has to have a great management team because increasingly, the longer I'm in this game, the more important and really the more importance we place on doing business with people of high integrity. So we have to have a great management team. We need a good moat, which is some aspect about a business. Maybe it's a natural monopoly, a patent, a trademark, economies of scale, something about that business that allows them to keep their competition at bay and safeguard their margins. And then we need a mispricing, because I think we can all readily identify great companies, but the challenge is to identify a great company at an attractive price, because without that price, we'll never have any success in in investing. So, okay, so with that overlay, I'll let Mike talk to you a little bit about Sprott Resources. This is one of the companies that serves as a general in our portfolio, and we've owned it for a while, and it's priced right, so we thought it would be timely to share with our clients today.
That stuff is depressing. Vern, I don't know why people call him pessimistic, but I kind of like it. I read the same stuff. It actually drives everything that we do here. In that we're, like you said, we're looking for companies that are priced right, that have good management teams, that are not going to be as affected by if Europe were to implode, or God forbid the United States starts to have some trouble where people start noticing. Then a company like we're going to talk about today, Sprott Resources, is actually going to do well in that kind of thing. They're going to buck the trend. And so we're kind of excited to bring it to you. I don't want to just sit up here and regurgitate facts necessarily to you about the company. I could probably talk for 4 or 5 hours about this company, so we're just going to briefly scratch the surface of this, give you kind of a 30,000-foot overlay of it. And again, it drives everything that we do in terms of trying to find a company that, first of all, in light of all that money printing, is going to do well. So we like things like real estate, although I've amended that a little bit and say paid for real estate, agriculture, hard assets, oil, gas, commodities, gold, silver. And so we actually also like the energy space. And about 50% of Sprott Resources assets are in the energy space. The increase in oil prices and things like that won't necessarily be good for our economy, but they'll be good for those companies that are producing oil, natural resources. So just give you a quick overview of the company. It's a public company, and they actually invest in other companies. And so in the natural resource space, including the precious metal, energy, agriculture that I talked about. The company went public back in 2007 at $1.50, and it's been as high as, it almost touched $6 in March intraday, but it settled at $5.90, and actually since subsequently has come back down to $4 a share, and actually yesterday it closed at $3.97, so it was under that $4 mark. Even at that $4 mark, it's been 166% gain since they started, about 42% in a year. So it's been a good investment, and we'll show you today why we think it's still very undervalued, very underappreciated. Vern talked about our 3 M's. It literally drives everything that we do in terms of the research that we do with these companies, and it definitely meets that, and we'll kind of talk about that as we go on. It's a Canadian company. We like the Canadian dollar. We like Alberta and Saskatchewan. That's where the bulk of their investments are. They've also got some in Manitoba and in Edmonton. And he kind of laughed like, well, why do we like Alberta? We actually have another company that we invest in called Pulse Seismic Data, or Pulse Seismic, that we did a lot of research on that Alberta area. Last year, Canada changed their tax laws, and it actually made Alberta a lot more friendly in terms of for exploration companies to come in. So we were actually watching the real estate trends in Alberta and watching that kind of go up and up and up, and that land's become more valuable. So, Ron?
They're going down, down, down.
They're going down, down, down now?
Yeah, they will be. If you look parallel, we just got back from a national convention, parallel to what the United States did, their affordability index for housing in Canada is too high.
Yeah, they've probably gone a little bit over. And so the thing, and we'll talk about this company owns one of the largest farms in the world, and they talk about the geographical diversity even within Canada. Helps them from a weather perspective, and what you're talking about too, just doing different things with different parts of land. But we still believe in terms of land. They're not making any more land, and so Sprott's got an expertise in oil and gas and in commodities for the most part, and with their connections, they have access to deals a wide variety of deals that you as the retail investor don't have, and we don't even have access to necessarily. And so, because they take part of their money and invest in private companies, not only public companies, but a few private companies. We'll talk about that. They're very attractive to partner with as a company. They don't have virtually no debt, And they have a long-term view of things, so long-term capital. They're somebody that, the normal hedge fund will go out there and lever up, take on a lot of debt, go invest in things. When the market goes south or when the companies start going south, these investors, you all come to the door and say, hey, I want my money back. The hedge fund doesn't have the money available to give it to you, so they've got to sell their positions, and depending on when they sell those positions, it could be a bad timing. So a company like Sprott that doesn't have any debt and is looking to do this for a long term is perfect to partner with, and that makes them part of that moat that we talked about, because they're looking at the long term, and they're not going to have to sell for long times, and they're very patient. They have a great reputation within Canada, and that's where the bulk of their investments are focused. I talked about it a second ago, but they have the largest farm in Canada. They're actually partnering with a native tribe called First Nations, and they're trying to bring mass-scale agribusiness to Canada. And there's so much open space out there. This is actually a farm that has over 2.1 million acres. And they're trying to be a lot more efficient with the use of their land, and they're also trying to help out their economy by hiring local residents. And then I've just got some stats on some of the startup in terms of, it's obviously a large farm. They've got planted acres, they have pasture acres, they've got grassland, they've got 9,000 head of cattle. So where's Sprott invested in? 49% of what they're invested in is in energy, 27% is in agriculture, and it's not just that farm that I talked about. They own another company called Union Agriculture. So about 27% of their investments are in agriculture. The precious metals right now are 100% consistent of gold. And I'll talk a little bit more about that, but that's been an incredible investment for them, and they've also got 3% in cash. A lot on this slide. Basically, it's just kind of showing the wheel. The numbers that I just gave you are updated numbers for this wheel. So that wheel is actually a little bit out of date. This was literally from the end of the year. It's changed a little bit. So this is, again, something we're watching all the time. Right now they have 8 investments plus gold plus cash are the 10 things that they have right now. I just want you to kind of concentrate on this number a little bit, and that's the market value that the company gives themselves, and that's right at about $600 million. We'll talk about it again in a few minutes, but the market cap for this company is under $450 million. So the company is saying, hey, we're worth 600. The market out there in terms of the stock price is only giving us credit for $450 million. So we'll actually show you where that $600 million number is pretty low. Again, this is a very conservative company, and even conservative when they're valuing their own assets. The one thing to bring from this slide, again, a lot of is this is a very conservative company, very strategic, very disciplined approach to going out and looking at deals. And we kind of took this number of 900 transactions that they've looked at. We take that with a grain of salt a little bit. Although we spoke to the CFO of this company two days ago for an update, and he was kind of adamant about that they look at just a ton of deals. I didn't talk about it at the beginning, but Eric Sprott's got a really good, he's got his name on the door, he's got his name on many businesses, and with his reputation, people actually come to them with deals saying, hey, what do you think about this, or we're looking to do this, or whatever. So they look at a ton of deals. This company's done a total of 10 deals, and they've only bought and sold, finished one transaction the whole time. So again, just extremely conservative. It's got to be something that's provable. And again, and the next slide is a lot of stuff. I just kind of wanted you to, it's kind of hard to see. I apologize for this. It shows the internal rate of return of the investments that they have. And the numbers, for the most part, are very positive and very good. And again, it just goes to their disciplined nature. And you'll see here they do invest in some public as well as actually mostly private companies. All right, just take you through a few of the businesses, and we'll talk a little bit more about this one later, because this one is this part of their portfolio is kind of wildly undervalued. But Waseca Energy is a company, an oil and gas exploration company in that Alberta and Saskatchewan area, and just make sure I get all the. management team that they have in place for this company has over 33 years of experience in the oil and gas industry. One of the things we like about this company is we actually watch their targets in terms of they're out there saying, okay, we're going to produce so much oil, and they gave a target of 3,700 barrels of oil for 2011. After just talking and confirming this with the CFO 2 days ago, is that they actually produced 4,500 barrels of oil in 2011. So they're actually ahead of their goal. They have a goal this year of bumping that up another 1,000 barrels per day to 5,500. And so when somebody says they're going to do something and then they go out and produce, that's what we like to see, obviously, and that's revenue in the door for them. So they've also, just a little kicker, is they've got 45,000 acres of exploration lands available to do a lot of things with. You'll notice in these companies, they're looking to sell these. They're either looking to IPO these companies, or they're looking to do a strategic merger with somebody, or outright sell these companies. And they're investing in these businesses to turn around and make a profit with them. And so that's just another catalyst for trying to move these things along. I mentioned it earlier, is the One Earth Farms. They're working right now at getting themselves ready for an IPO. Realistically, after listening to an hour-long conference call on just this company, this part of their company, it's probably 18 months to 2 years away, realistically. It's a young operation, even with that much land. They just did their first deal within the company. They bought the 5th largest farm in Alberta, and what they got out of that was some really good, trained, qualified people. They got some used equipment, got a ton of land, and so it looks like it's a really good deal. I'll show you later too where the market's really giving no value at all to the agricultural section of their business. And we like that. This is just another small oil and gas firm that they have. Again, a lot of potential with this. They're partnering with that native tribe. In 2010, they had basically zero revenues. They had $2 million of revenues last year. So it's a small part of what they're doing, but they're definitely going in the right direction. And again, they seem to know what they're doing in terms of the drilling and exploration. And so we think this could be a home run. Again, getting virtually no value for this. Another part of their energy their energy space is a company called Westfire, and they just did a strategic merger in the middle of 2011 with a company called Orion. Too complicated, but other than that, they started out, they invested $100 million. On this slide, at the end of the year, they valued the company at $163 million. It's a publicly traded company, so we went out and did some due diligence, and we personally value the company at about $150 million. Still, very good return on their investment, and a lot of upside to this one also. And this again is they're trying to sell themselves to a larger player at some point. So if we step back and just do a real quick recap right now, and then also add a few other notes. I talked a little bit about Eric Sprott earlier. He's actually an 8% owner, owns over 8 million shares of the company. The other insiders and executives within the company own another 2%. So here you have a company with insider ownership with skin in the game of 10%. When I was doing this slide and again talking to the CFO, I was kind of thinking, our little firm is kind of like this too, is we have skin in the game. He talked about that. We've got a conservative, disciplined approach. Deep value. We're looking for deep values, and we definitely think we found one here in Sprott. This next part is buy low, sell high. It sounds so, come on. But it's harder to do that because you really have to have, again, a disciplined approach. A lot of people in the market today are into this momentum game of let's buy it high, and then we'll try to sell it higher. And we just don't think it's a sustainable strategy long term, and neither does this company. We like that. So they don't look for companies with exploration risk. They're really looking for things that are provable, looking for resources that are mispriced. Management definitely has a proven track record so far. The next statement is something that the CFO gave us and said that 4% of the management teams out there create about 64% of the value in the mining sector. I'll take some of those numbers with a grain of salt, but it kind of blew us away because it blew the old 80-20 rule out of the door. It's even more for management teams within the mining sector, and we think we have one of the best in this company. And I talked about it earlier, but the current market cap of the company is justified without the entire agriculture and probably without the cash that they have in the books, which is about $20 million. The company's so frustrated by the market not giving them credit in terms of their stock price that they're actually actively trying to buy the stock at 49,000 shares a day clip. They're so frustrated by it. I think it's such a great value. So we like that the company's out there trying to buy their own stock back. Just a quick valuation of the company. Run down their cash. They have $20 million. They have gold. They have literally 73,971 ounces of gold. We just put a price on that of $17.15, which was a price from 2 days ago. The 100-ounce price, if you're selling 100-ounce bars of gold, is actually about $1,750 an ounce, but we just gave it the more conservative, so it's worth about $127 million. The agriculture I talked about, I didn't even talk about the last company there, Stonegate. It's actually a company that is looking at, they have phosphate deposits in both Peru and in Idaho. Phosphate is put into fertilizers to increase the yields that farmers are putting on there, and so that's got some upside, and again, getting virtually not much value for that right now. In terms of their energy spaces, these are the different companies that they own. Waseca being private, Westfire, Guide, One Earth, and Virginia are all. One Earth are all public companies, so we can tell exactly what they're valued at. If we add that all up, it adds up to $698 million. We'll go ahead and take out the liabilities of $60 million that they owe, and we get a net asset value of $638. So I told you on that other slide is we were looking at about $600 million, and we've found an extra $38 million worth of value to this company. And again, with the market cap being, actually it was less than $450 million as of the close of the day yesterday, but let's just say, so the price of the stock to the net asset value is about 71 cents. So you're looking at about a 70-cent dollar, we call it. So, are there any questions? It's kind of a complicated thing. I don't mean to make it that way, but real quick, the way we look at the Waseca Energy is they have that on the book on that gray slide back where it showed you what they have on their books. They actually have this on their books as their original investment at $44 million. This company actually produces 4,500 barrels of oil per day, and they do that at 365 days a year. We just put a conservative, these companies sell their barrels of oil at different prices. Right now it's well over $100, but we just put an $80 barrel on it, and you get $131 million. I'm slipping down to the bottom one. And if you divide that by the market cap of the company, you could actually pay for this entire company in about 3.5 years with just their revenues from one of their companies. And so that is obviously attractive to us. The multiple people put on things is you get $500,000 per barrel of oil per day. It's kind of how you value these companies. And if we put that on at 4,500, come up with $225 million is the value of this company. It's a private company, so even if we slap a really high discount of 20% on that, we're still looking at a $180 million company. And so, again, being very conservative, they got it on the books at 44. We think it's conservatively worth 180. And then if they were to get the 225, that's just an extra 45 to 50 cents on the stock, on a $4 stock, is a nice return in itself. And then I'm not even putting on the extra 1,000 barrels of oil that they expect to pump this year. So again, being very, very conservative with this valuation. Are there any questions? That's Sprott in a nutshell. There's so much within each one of these companies, and that's what we do. That's what nerds like Vern and I like to do. is go in and dig into these companies. And so we're looking at each one of these companies, and so this was just kind of scratching the surface today. But so anyway, anybody have any questions for us?
So these guys reminded me of a little company that we looked at about, oh, it's probably been about a year and a half ago, called Brookfield, and we did one of these events and we walked all of our clients through Brookfield. And Brookfield has timberland and transmission and distribution lines and real estate and the largest coal terminal in Australia, and just a lot of moving parts. And I remember doing the slideshow that it was seemed like a real hard company for everybody to kind of wrap their brains around while we were giving it 20 minutes of attention. And Sprott's kind of the same thing, but they have all of those assets that fit with that macro view that I was talking about. You have rising populations, which benefit all things agricultural. You have declining water supplies around the globe, which should benefit any company that's involved in farming or farmland. You have gold and oil, which are hard assets that are denominated in dollars. So to the extent that the United States has to increase its money supply to deal with these massive debt loads, then any commodity that's denominated in dollars should benefit from that. So Sprott has all these little pieces that we like, coupled with a great management team and a hidden gem like Wasaka that tells us that we can buy a $6 company at least for $4.50. And it has it becomes one of those generals inside of our portfolio that we think we can hold for 5, 6, 7, 8, maybe 10 years. But there are a lot of moving pieces.
There are. Well, I appreciate your time today. Help us spread the word with this. We're obviously trying to educate clients, get people networking-wise together. I was going to have a few of you, most of you guys know each other, I think. I was just going to have a couple, maybe have Brad say who he is. I know he's looking for a job, so if anybody knows, we want to definitely help him out. As you know, Brian Mickle is also. So I'm going to have you guys just go maybe give a 30-second, 1-minute spiel on you.
Some of you know me. I'm Brad Connor. I'm a parish member over at Holy Cross. I used to own and operate my own business, Free Bath, Kansas City, for 12 years, and I sold it last April. And I'm in business development right now, but the company I'm with is having some business struggles, put it that way. And so I'm looking for something, I'm keeping my options open for several different areas. So I can give you my number if you need it.
Yeah, and I've got his resume and all that. If people say, hey, I can maybe help that guy out, what was his name or whatever, just kind of contact me if you didn't get hold of Brad personally.
Brad, what's your background? I mean, so far,
yeah, it's diverse. And that's kind of what I've told everybody. I've got a diverse background because I ran my own company. But bottom line is, when it comes down to it, something in management, business development area. I've got finance.
What was your company?
Oh, Rebath in Kansas City. We were bathroom remodel.
Oh, okay. All right. That's helpful.
So I did a lot of production management, supervising.
Got it.
My name is Brian Mickle, and I've been an executive running sales organizations, large ones. My last stint was 350 sales reps, so, and also small ones as well. And I'm out networking, talking to CEOs. So those of you guys I haven't met yet, welcome to meet you guys and have coffee. What I'm finding is I've probably met about 80 either SVPs or CEOs of companies in the last 4 months. And so if I know what you do, I can definitely connect, because that's been working real well. It's interesting how you meet somebody and say, oh, you need to meet so-and-so. You create a lot of relationships that way. So be happy to help you guys out as I'm doing my search as well. So.
Any other guys want to tout your businesses or whatever you're doing, please do. Ray, I appreciate Ray's my life and business coach. So I'm glad he's here.
My name is Ray Ryder. My company is called Kaizen, and basically my whole purpose and focus is on unfettering your potential to help you be your best as a small business owner, as an entrepreneur, as a professional. I do have the opportunity to work with Mike right now on his business and life coaching. My specialty is around structure systems to help, again, business owners and entrepreneurs. My background is in financial services, 21 years with American Express Financial Advisors, and this month Kaizen turned 10 years old, so I'm pretty excited You made it 10 years, man. So, and Kaizen means continuous improvement, so that's my passion. Thank you.
Awesome. Ron's our realtor extraordinaire. Bo's our insurance guy. A lot of other things too, but a lot of other businesses. So next one of these is Wednesday. Sorry about the Thursday. I hope I didn't mess anybody up. We were trying to keep this consistent, but things happen. So our next one's Wednesday.
I was the only one that messed up, just so you know. Because I was in the parking lot and I was the only one here, just so nobody else.
So Bo's our most dedicated this week because he came twice. So, so next March 14th. We try to get these out from Constant Contact, from LinkedIn. Yeah, if somebody wants to leave me an email address, say, hey, I'd really like to come to these, or at least get invited to them. Please leave that with us. I think we get everybody here, but I mean, we do these for networking, and you guys did that. I appreciate it. And then we also have another investment club that meets once a month on the fourth Monday. We're consistent about this one. Fourth Monday at 5:30 p.m. Bring a little barbecue and some beverages and get together. We actually roll up our sleeves. And a company like Sprott, we would go through a lot more in depth, and then people come with their own ideas, and we kind of round table those. And it's a good discussion. There's about 10 to 15 of us that come on a consistent basis, and it's a pretty good group of people too. So if you're into the stocks and like to look at that kind of stuff, it's kind of fun. So please eat food and network some more and enjoy your day. Thank you.
Thank you.
Thank you.